Market Prospects, delivering timely information and education to prairie farmers for over 30 years. Market Prospects is brought to you by the University of Saskatchewan's Department of Agricultural and Resource Economics and these sponsors. Log on to marketprospects.usask.ca to view past programs and for information on upcoming programs.
On Market Prospects this week, a detailed overview of the canola situation and outlook. Joining us in studio is Dr. Derek Brewin, Department of Agribusiness and Agricultural Economics, University of Manitoba. Great to have you on Farmgate.
Nice to be here in person. Nice to see you.
Okay, right off the top then, what is the current situation in canola markets and what can we expect for movement in prices as we approach the end of the current crop year?
Well, the overall world supply of grains and oilseeds has been really good over the last year. We had 3 billion tons of grains supplied to the world market last year. We had record crops in the United States and Brazil. Brazil had some currency trouble, so that made pretty low price soybeans coming out of Brazil, and that led to some buildup of stocks in the United States. They've got 12 million metric tons of stocks right now. 2 years ago, that number was 2 million metric tons. So that's putting downward pressure on the price of soybeans in the United States. There's some good news. The dollar, our own dollar, fell through that period, and that kept things not as bad in Canada as they were in the United States. And we've had really good crushing margins. That's led to good crushing pace, and at these prices and a pretty good winter, we had a pretty good export program. So we actually have pretty tight stocks for canola coming out of this year and forecast for next year. So, you know, the overall position is there's been some downward pressure on price because of the export market, but our own Canadian position has kept things fairly tight on the basis.
So give us your canola price and acreage forecast for the coming year. And should farmers be locking in prices and also basis now?
Well, on the area, I look at budgets for the different crops, and you know, I think some of your earlier forecasts, they've said that the pulses look pretty good, and I would agree with that. Pulses look good, but I don't think that's going to hurt canola so much as it's going to hurt grains. Canola still looks pretty good to the Western Canadian producer in terms of their return per acre. So I think we'll probably see flat canola area or slightly a slight increase, which is what Ag Canada is forecasting. On the basis, the domestic crush, you know, it's been good. I think, so we've seen pretty good crushing demand and export demand, and that's meant that our export basis is pretty good, but there's lots of upside risk on that. You heard Dr. Gray the other day saying that that was a possible threat to the prices is a big export basis, and that's possible if we see a big crop. On the basis against the futures, right now we've got firms offering prices above the futures for nearby delivery and only $14 below in the fall. So those are pretty good margins. I think if we get an average year, we'll go down another $10, $15 on that basis. So these are pretty good basis to be locking in as well. So I think if we get our trend production on the soybeans in the United States, we could get back to those early May low export prices. With the current dollar, I think that means that our elevator prices around here would be $9.80 to $10 a bushel. That's kind of the most likely price. There's some downside risk if we see demand falling off in Asia. We could see a wider basis because of that big crop. So it's possible we get prices below $9, but I don't think that's very likely. On the upside, I think the big factors are growing conditions. If we see bad crop in the United States, lowers or increases the price all over the world. Bad crop in Canada means that tight basis we got right now stays tight.
So what are the rates for canola crush and crushing margins this year versus last year?
The Intercontinental Exchange puts out their basis using soybean meal and soybean oil markets in the United States and converts them to the Canadian dollar. And right now that's at $90 a ton. And last time we talked, last year, it was at $90 a ton. But in the summer, it went down to $40 a ton when we were worried about production. So there's some room for the crushers to give some of that margin back to producers when there's a tight situation. But you've got this, you know, we have a really big export program, but we've got possible made in Canada prices. The Altona plant has a spot price of $490 a ton. We've got futures contract here in Saskatoon is trading at $4.80, and then according to ICE, the reported Vancouver price is $409. So that means that export basis is razor thin, or that $409 is not trading very much. Those are good returns right now. I think we could see Ag Canada forecast a crush this year at 8.1 million metric tons, another 8 million metric tons in the new crop year. They might give up some of that to the producer, but we could see, if we see a big oilseed crop, we could see export prices down. That could hurt that crush margin, and they wouldn't have as much to share, or a stronger dollar could hurt that crush margin.
Is there a key factor that canola producers should be aware of as they make their final seeding preparations?
I think the big thing in the short term is what happens to that soybean crop. Right now, in the last forecast, they were forecasting corn area up, soybeans flat or down. Right now, at the current prices, I think we could see soybean area go up, because the current soybean prices are actually looking good relative to corn. That would be the one thing that shifts through the crop year. I think it would be weather and the dollar.
Great information. Thanks for coming on Farmgate.
Thanks for having me.
Okay, we'll break again. We're back in 2 minutes. Please stay with us.